would like to welcome up to the stage Jeanne Campanelli, who brings 25 years experience as a corporate and securities attorney. She's on the management team of CrowdCheck, which provides due diligence, disclosure, and compliance services for online capital formation and helps investors get the information they need to avoid fraud. Jeanne's going to be moderating the Q&A time here, and hand it off to you.
Thank you, Jason. Thanks. Hi. I came up with a list of questions. It's pretty long, but I noticed during your presentations, I think some of these got answered, so if it sounds like I'm covering ground that's already been covered, hopefully you can give us a little more details on some of the issues that arose. And like Jason, unfortunately, I need reading glasses to even though I typed this really large. So actually, for Ronn and for Tim, what do you think was or is the biggest benefit to your business of using Reg A to raise funds? It's right there.
Is this on?
I think it's on.
Hello? Hello? This one's not on. So the question was,
What do you think was the biggest benefit of using Reg A after all the agita that you guys described?
I think among all the other things that it did do for us, I think it just really, it got me off dead center, and it forced me to, focus, find out what I shouldn't be doing and what I needed to be doing, and we used it like a focus group, and it allowed us over time to do a lot of fine tuning. I mean, we're not nearly we've only been at it for just barely a year, and we're an entirely different company now, and our spiel, if you want to call it that, as we meet with investment and private equity guys, venture funds, all those things that were just discussed here, we're much better at it, and we have a much broader base of people who know that we exist right now. I think that's, for us, that was the biggest benefit. Would you agree?
Yeah. I'd have to say, and maybe I mischaracterized this, the SEC was outstanding to work with. It's just we were first. And so there were a lot of questions. We were asking a lot of questions, and they would get back to us quite quickly. So we had a great relationship with them. What it did for us is, number one, we're operating as a public company. So we had to grow up really fast. And I'm just speaking from a marketing standpoint. That meant that all of our voices across the line had to be speaking with the same message and the same cadence. And that's critical. So we grew up, and it's been an awesome experience. And of course, we were able to really engage and connect with our customer base.
And let's go back to, I did talk to Chris a couple days ago, and one of the things he and I thought about was, could you share with the audience, and I think you shared some of the hiccups you sort of hit along the way. Chris, I know you started to talk about the auditors, and it sounds like everybody's hit some sort of auditor hiccup. Was it just the fact that you needed somebody who was PCAOB eligible, or?
Yeah, we went through, so I'll give you the full spiel. First and foremost, we had to go through probably 2 rounds of upgrading our existing internal team, because we came to the conclusion, or based on the advice of our auditors, that we thought we had good financials and we thought we had qualified help, but we didn't. So we had to go through a couple rounds of that. So first and foremost, before you even hire the expensive firm, go out there and make sure you have a really solid team. And sometimes you can get some advice from these firms to do that. The next thing we figured out was that even though we had a great firm, local national firm, auditing our private funds, because they weren't PCAOB qualified and they don't allow their reports to be in a public report, which you would think wouldn't matter because we weren't taking those companies public. The fact that those companies consolidated into, from an accounting standpoint, consolidated into our parent company, and the parent company was going public, those audits also had to be PCAOB qualified. So we had to redo like 18 now different sub-fund audits, which was a lot of work, right? So we've actually been audited like, I think, 24 times or something like that. You know, when you add up all the companies and all the years that we've been audited for. So the strategy there is important. And if you're a younger entrepreneur or you're just starting to build a business, I've made a personal pledge for the rest of my life that I will never start another company without getting it audited annually from scratch, because when you need those audited financials 5 years down the road, going back is brutal, and I'd rather spend the money up front. So
And
just a life lesson.
Just to add to that on the auditors, and then we'll hit a couple of other hiccups. One thing that we've run into a lot lately, and I think I surprised somebody this morning when I mentioned this, is we've had a number of our clients say, get their financials audited, and then when it came time for the auditors they have to sign a consent with the SEC. And when it came time for them to sign it, they have to state that they're independent. And the SEC has a lot of independence rules, and we have run into 3 clients in the last 6 months where the auditors said they couldn't be independent. And you may kind of shake your head and say, how could that be? But for a lot of very young companies, the auditors they hire sometimes work on, let's say, writing the notes to their financial statements. And under SEC rules, one of my clients, in 2014, their auditors wrote the notes to their financial statements. And in 2017, they said that was too short a time ago. We can't hand over heart say we're independent. We wouldn't qualify under the SEC's rules. So another thing to think about is, you know, to your point, your internal team is supposed to be doing your financial statements, and the auditors just audit them. And we've run into a lot of places where the auditors try to help out, and it turns out it's a problem down the road in Reg A. Any other hiccups that Elio or Ronn Motors can think of that you don't think you had gone over in your presentation?
I would just agree, you know, about the auditor thing, but you'd mentioned that one of the things that we've learned even in this short time in a year, we've already had a complete turnover of who we started working with, because we found out pretty quickly, and we do a lot of our own stuff internally now. We're very cautious now, because there's a lot of groups out there that say they can do a lot of things, and you're talking about, they were great at the $5 million level, but we're talking about $50 million level, or maybe $100 million level, or I think you guys are maybe $400 million on a big factory. And the original team that we were working with didn't have a clue what we were talking about. You know, and they did the best they could. I'm not saying but they just weren't used to this space either. And so we replaced everybody but virtually myself, and I'm a little nervous even today.
I'm not a recovering accountant, and I'm a marketing guy. I'm just a caveman. But I can tell you, my CFO during the whole process, I would call her up and I'd say, Connie, how's things going? She's like, I'm in the middle of an audit. But we had an incredible team. I think we pretty much went through it, you know, exceptionally well. So, and that's a real testament to both our CFO, the folks that she brought in, and also our legal team that helped us out. So.
For each of you, is there any one thing you wish you knew before you started the Reg A process? That I know, Chris, you've actually done a very good job of highlighting some of the issues, but is there one thing you think is something you'd recommend to everybody that you learned that you wish you had known from day one?
I would say, I think it's a business lesson in general, that we actually did an awful lot of vetting of the people we hired before we hired them, you know, even the first round of people that I discussed. So the first gentleman who helped us on the capital markets advisory side, we got to know him over a year. We spent 6 months looking into his background. We actually found through common connections through my wife, who used to work at PwC in Austin, Texas, who also worked with a guy who eventually became the CFO for a company that he helped take public. You know, we had this really random sort of, you know, way to see more or less whether he was legitimate. And we spent all the time looking at the backgrounds and their experience. And something that we've learned, or I've learned more recently, is the one thing I didn't do was make sure that the values lined up. Because he had the experience and he had the background to a certain degree, but the values didn't work. You know, he just had different values than us. And because of that, it didn't, you know, we weren't going to go anywhere. And I think that works across the spectrum, your attorneys, do you have the right value set with your shareholders or future shareholders you're trying to market to? Do you really care about the success of them financially, or are you just using them as a means to an end? Because if that's where you're going, you're not going to be successful. Even unsophisticated retail investors can smell it. So you've got to really make sure that you're in alignment, that you really believe in the success of your own business, and that selling shares of your company to people is something that you believe in because you're in alignment with that. That's in your value set. That's my lesson, and I think it applies across the board.
Yeah, what I think we did right is we're an extremely transparent company, and there was just an utmost high level of integrity that went into every single word that we put down on a piece of paper and every message that we put out there. And the folks really responded to that. They asked good questions. Paul even got interviewed by Motley Fool, who did a wonderful piece on should you invest in these things. And we were able to disseminate that out to our group to let them know, here's the risk. So.
I agree with both of these gentlemen, really smart guys sitting here. I guess maybe for me, one of the greater difficulties is we're very good at building things. It doesn't really matter if it's a company or a car or a piece of technology. But to do those, to build anything, you got to know what the boundaries are. Reg A Plus, even today, 2 years after they first launched the thing, the boundaries are ever moving. I'm willing to play all the way up against the boundaries on both sides. I just need to know what they are. And so you're always, your attorneys don't really know all the rules. They get updates every day. Your broker dealers don't know half the rules, and they have to get updated every day. And so you're sort of, you're hanging out there as a business owner, and you have to make decisions that you don't really know if you're right or wrong, but you got to make that decision and just hope that somebody at the SEC doesn't feel bad the next day and change the rules on you. It's a constant. Right now, it's still a moving target, and they're constantly refining it for the better. But you just never know when that rule's going to change.
So, talking about the what you can and can't do, was there anything that you learned when doing testing the waters that you could do, couldn't do? Any sort of words of advice on? I know we've been talking about how the good news about Reg A is it allows you to do a level of promotion you really can't do in the registered world. But there are still guardrails. I don't know, did any of you kind of run into your lawyers throwing up guardrails?
No, not on our side. The only thing that I don't like being told I can't do anything. So that's comes from being a rebellious child, I guess. So they told me in the beginning that I couldn't build my own platform. That was very irritating to me because I said, why can't I do that? Well, you can't do that. Well, there was no reason for why. And so we ended up doing, rather than putting all of our stuff on somebody else's platform, we decided to, because I like building things, we built our own platform. Pretty challenging. We had some really sharp guys to help us with that. And so we managed to put together our own platform, and we learned quite a bit about Reg A offerings in the midst of all that. And we were able to create our own database of people coming in and stuff and not having to build it for somebody else. That was a good thing for us.
Spam filters. Enough said. I don't know if you guys have ran into those, but when you're trying to send out a message to invest or equity and you use words like that, spam filters, we were losing 40% of our email. And so, but if our partner Start Engine sent out the email, they would only lose 15 to 20% of them based on what their business category is and the information that they were sending out. So you have to be really up on the digital in the keywords that you can use. Like I said before, explaining to folks what an indication of interest is. What does that mean? Another thing we did with the Start Engine platform, I researched Chase Bank, Wells Fargo, Merrill Lynch, all sorts of different websites to see how you make a transaction, how you make a wire transaction, because a lot of these will be ACH or broker or whatever. And I hope it's better now, but when we originally talked to them and got that system set up, we wanted it to be familiar to our customer base, so that when they came to the day that they were going to make a transaction with us, that it felt as easy as doing a transaction on your Wells Fargo bank account. Now, when I first got the paperwork of what that transactional process had to look like, that's when my hair turned white. Because it was asking for so many steps, so many disclaimers and different things that from a marketing standpoint, I would just talk to Paul about it and I'd say, okay, they're gonna read the first 2 lines, then they're out. Then there's another group's gonna read the next 4 lines and then they're out. So there was a lot put into that whole process, and I think Start Engine's got a good platform for that now because of our relationship with them. Oh, Fund America, absolutely. I can't say enough about Scott Purcell and his company.
So we're still testing the waters, so you can go to calibreipo.com and see that. We haven't launched any sort of marketing campaign for that because we haven't been ready to yet. So I'll give a shameless plug for Big Yam because I'm waiting for Ryan to give us the master plan or something like that. He's over there. But yeah, we're building this master plan because when we looked across the board, and this, again, to inform anyone who's an entrepreneur thinking about this, there's always been B2C marketing, business to consumer, right? B2B marketing, business to business. Until Reg A Plus, there wasn't really a reason to have B to O, business to owner, or business to shareholder, if you want to call it that. So until a couple years ago, there wasn't any reason for a marketing firm to know how to cross-market your customers to become owners of your business. And at the same time, the IPO market has always worked so that, you get qualified, you do an institutional offering, you fit the box, you check the 18 different boxes, and once you've checked all those boxes, you go on a roadshow where basically an investment bank puts you in front of institutional investors and you do 10-minute pitches and you basically do sales pitches constantly to institutions. Well, investment bankers have never had to be marketers either because the roadshow is the roadshow. There's a list of people you go to, they build relationships in this community. They're going to line up 40 people for you to meet in New York. It's the same 40 people every time. So there's no reason for an investment banker to become a marketer. So until a couple of years ago, there was absolutely no reason to have a category in these worlds that would touch. And then now, all of a sudden, marketers need to know how to market to owners, and bankers need to know how to market or need to know how to integrate their traditional services with a marketed offering. So that is really difficult to figure out. But good news is that a lot of smart people have trailblazed for us, and so people are picking it up. Big Yam's a great agency. They're figuring it out. Ryan spent years researching this before he even thought to try to provide services to the industry. So I think that it's a huge opportunity for us. I'm in a bunch of these CEO groups, and I listen to CEOs all the time talk about, well, I can't sell, my kids don't want the business, I don't want to deal with private equity, I don't really have. I'd love to give the company my employees, but there's no actual way to do that makes sense a lot of times. And so I think this is a tremendous opportunity for a lot of people to transition a company to the next round of ownership, create a way to make it through ups and downs and cycles, and frankly, get the money that you need to take a business to the next level. There are a ton of really well-run businesses that'll never see the light of day because they can't get capital. And I think this is a great way to do it. So I know that didn't answer the question, but.
That's fine. 2 more questions, and then I do want to open it up because I saw a lot of people eager to ask questions when Tim got up there. So did any of you open your offering to international investors, and did that present any sort of marketing or other offering issues?
No. We didn't close it off to international ones, but we weren't really marketing that direction. We will in the future, as we circle back around and recover our seed round money, and then we moved to a listing. I'm sure that they'll market overseas investors as well, but we didn't originally. no, not by any plan. We just didn't do that.
In Elio's case, did you go
We
to?
didn't focus on that in our marketing.
No?
No.
Okay. And then I know this has been talked about a little bit by several people, but does it bother you that there's been negative reports about Reg A trading and liquidity? And what do you say to that?
I haven't seen those reports. There's always going to be challenges in the marketplace for, I think, any of the new companies getting started. You know, like you, I think you had said before, or Mr. Schweikert maybe said, marketing. No, it was you. I'm going to give you full credit.
I don't know if I need
Continuing to market your company so that it gets exposure, so that the market can see it, and that's a big thing if I'm answering your question correctly. We've had a lot of people contact us since we went through the process. Paul gets a lot of calls, and I've had a lot of folks reach out from a marketing standpoint. I think people are finding out now that it's a balance between obviously finding the right team, having the right legal folks. There's a lot of folks that have gone through it now, which is really nice. And then understanding what your marketing limitations are. You know, can you go to the crowd? Going to the crowd is very difficult. You know, it's like my grandfather always said, you know, it's 80% your brain, what did he say, 25% your money and 5% luck, you know, and that's how you're going to get a business going. And it's true. I mean, we had a lot of luck and stuff that fell in our place, on our plates. And I have to say the biggest thing that we had that drove us across the line was our fan base. And we take care of them. Those are some of the most important stewards that we have out there right now speaking our language. So
Actually,
I'll just say this about that. I don't know that, I could probably say this for everybody sitting here. We're all entrepreneurs, and I suspect most of you people out there as well. We wouldn't be entrepreneurs if we were really swayed about what people said.
Right.
I've been told that, you know, you should never go public. You should go public. You should only do private equity. Oh, you should never do private equity. The market's going to be up. Are you stupid? Oh, the market's going to be down, or you're an idiot. You know, it doesn't really matter. So I think, and one of the key things for being an entrepreneur is a high tolerance for pain. And so I think we're all kind of used to that negativity, and it just goes in one ear and out the other.
well, actually, something Tim just said made me think of this. So now that you're a reporting company, do you communicate differently with your investors and your fan base?
absolutely, absolutely.
And how so?
We hired an investor relations firm. We hired an investor relations person. So that whole communication we know could be monitored. So you want to make sure that you're doing that at the utmost standards, and you have to take that into consideration before you do this, because that's a full-time cost. And so.
It is that.
I'll just add on the last question. I think it's important to frame the news, right? We're in the real estate business, and the news in real estate is driven by what's happening with multi-billion-dollar institutional real estate sources, and that's what CNN and yada yada reports on. So they are overpaying for apartment complexes right now. That doesn't necessarily mean that anything in the news has anything to do with what's going on in Phoenix, Arizona, next to Grand Canyon University at student housing. You know, it has nothing to do with it. So you're looking at a nascent business that has started with one of the best funding vehicles that's been released, as Congressman Schweikert said, ever, that's basically allowing the stock market to become what it used to be, a way for you to buy into brands that you liked, cared about, and wanted to see succeed. So conceptually, it's kind of like eBay when it started, or Amazon when it started. You try to evaluate eBay based on the first couple companies that started selling products on eBay, and you're trying to look at that narrow little gap to say, are these guys being successful or not? Is eBay good or not? I think if you take a step back and see the bigger picture of what's going on, the investment bankers, the investment class, the hedge funds, the private equity groups, all the people that aren't investing in these deals right now will flip a switch one day and all of a sudden, hey, these companies are making money. We want to buy these things. They don't care. And so all of this is going to change, and it's going to change a lot faster than I think anyone's really expecting. So as investors and people in Arizona, what I would submit to you is that I've sat on these sort of Phoenix Business Journal panels where we talk about why venture capital and private equity won't invest in Arizona businesses and how hard it is to get people from New York to come to Arizona and help fund our companies and that kind of stuff. I'm sure you guys have seen that, right? I just think it's dumb for us to focus on the old way of funding businesses when a new way of funding businesses is sitting on our lap, and it's a very Westerner kind of anti-establishment opportunity for us to just fund our businesses ourselves with our own community. 65% of our investors that have built Caliber are in Arizona. We don't really have to go that far to build a great business. And so that's what I would say is that I know there's negative news, and yes, I am concerned about that as it relates to our offering and the success of our offering and the stock and things like that. But from a bigger picture perspective, is Reg A plus good or bad as you're trying to make that decision for you? I don't think that we have enough data.
Cool. Well, why don't we open it up to questions? There's a gentleman over here.
I'm Bob Rogers. Jennings, pardon me, I guess I didn't get ready. Jennings Strauss. The secret ingredient wasn't mentioned today. And the secret ingredient hasn't been available for smaller companies in the United States for about 30 years. And that's analyst coverage. You can't always trumpet your own company and its success. You have to have a third party who looks at your company, examines it carefully with due diligence as you go, and then puts out regular reports about it. Now, this was stopped when we moved from fractional trading, eighths and quarters, to decimal trading, and there's reasons why that happened. But it was dropped except for the largest companies. Now, where it wasn't dropped was Canada. I'm a New York attorney. I practiced many years in New York taking companies public. And in the course of doing that, I learned that they won't take anything there that is smaller than about 300 market cap, 300 million market cap. And here we are in Arizona where that isn't our standard. We can't do that. We started looking around, where do they still do that? Or where do they do it? And 10 years ago, we started finding Canada, which I had always thought was a hotbed of fraud and manipulation, and that was the bad. Any reliable securities attorney would have told you that. I went up there with that attitude and had my attitude changed. So we took up, one company got a private placement, they had no revenues, raised $15 million at a $30 million valuation. And it was done by investment bankers. And what they will always do, we didn't take it public. We got a private placement with a commitment for a liquidity event later, 18 months later. But what they guarantee you, once you are public, and you can go public on their TSX Venture Exchange or on the big board, the TSX, the Toronto Stock Exchange, which is the third largest equity market in the world. And it's not just oil and gas. And so if you go public up there, you're guaranteed at least one analyst. And the larger you get more analysts. And they're a country of entrepreneurs because they funded all of their natural resources developments with small public companies. So they're used to investing as a people in smaller enterprises. So they don't see it as a risk, they see it as a risk to be balanced, and they'll put their money in multiple companies. So when they started coming down here, we invited the Toronto Stock Exchange down here. They were just here for the last time on October 24th. They've been here 8 times. And they now have asked me, figure out how you want us to present it to the community in Arizona. We've been there 8 times. We have all the money that you need. The investment bankers tell me we have more money than we have deals. And here we are, Reg A. I told David Schweikert when he was here, we keep a picture of him with a candle burning in my house because he is the saint of the Rogers residence, okay? And the Reg A has opened up Canada to us because now the Canadians were frustrated when we couldn't sell Canadian raises in the US because it wasn't registered. Now with Reg A Plus, we can do that almost automatically. And so the Canadian brokers have the biggest market, and the one they love the most is the US. So you go public up there or private, public, and then you can sell into the US with analysts. Now, my strategy has always been, you start going that way because it's cheaper and eventually come on to NASDAQ. Now, I took my own company, a medical technology company, public on NASDAQ back in the 80s, if you can believe it. That's when NASDAQ would do early stage companies. And we raised 13 million in current dollars back then. You can imagine what that did to a startup company. But that was because they did it then. Now, the Canadians are still doing it. And I really want to thank each of you and everyone who's participated here, because this is what we need, this kind of conversation. We needed Reg A+. We need to see where all these things are. And I add to that the London Stock Exchange, who offered a $30 million public deal to that same company we raised $15 million for. And we brought them here for the first time. They thought they were going to be met by Indians at the airport. You know, they had no idea what Arizona was like. Now, I'm not really asking a question, but I just want to make a point that keep in mind, analysts are professionals, they're independent, they review your company and put it out for the public to read. And the analysts that are in the investors' side read those analyst reports, and that's how they decide whether your company's doing well or not. So analysts is what we're missing. We didn't have it in our vocabulary today. Isn't that funny? And yet that's where the heart of it is. That's where the frustration is, that after we go public, say on over the counter, and may you rest in peace if you go to the over the counter. Let me just tell you that. Do not do it. Don't merge into anything, okay? I'm just giving you free advice. There's no bill coming. I'm just giving you true experience
There's no such thing
on
as a
how
free
these
lunch.
things go. And I've done so many of them. And, you know, one that I did, I'm sorry to talk so long. It's not,
No,
one
but
that,
to your point, like when
Yeah.
regulation crowdfunding, which also didn't get mentioned today, it was also part of the Jobs Act. One of the very first clients I worked with under regulation crowdfunding was a company in Minnesota that said somebody needs to write research on these companies so that people can understand them and decide whether to invest. And
it's so true.
they tried it for a while, but they had to figure out a way to fund their model, and they tried to do it by subscription. And you know something?
Doesn't work.
Yeah, startup investors are not going to pay $10 a month to do it. Do I think eventually I think once Reg A gets some momentum, you're going to see this kind of following, but unfortunately, and I worked at Citigroup back in the early 2000s, back when the whole Jack Grubman thing blew up, so I know a lot about research at this point, because I covered that business, and it will come, but I think it's really sort of like the tail, unfortunately.
Well, I think just because I'm the king of shameless plugs today, the gentleman standing behind you, Mr. Merriman, his firm is the largest producer of research for companies that have $1.5 billion market cap or less in the country. So if you want to go twist somebody's arm,
Yeah.
he's there for twisted.
Let me comment. Chris, thank you. Thanks for your comments. You're spot on. But we cover about 530 companies, so research is still alive. We do have to monetize that research, and sometimes we do it through advisory agreements, but I totally agree. And if you guys want to complain about the lack of research, you should talk to our governmental bodies and FINRA, because they put a stake in the heart of effective research. So I totally agree, and I think it's a very important mechanism, and but it's not dead yet. I mean, we're still doing it.
Glad to see that. Let's talk.
Good.
Any other questions?
Why do we not have a TSXV-like exchange here? Why are we using Reg A? I mean, that's what I thought the whole time. Yeah, I mean, the TSXV is great. It's, you know, minimal investment.
There's two exchanges there, the TSX Venture Exchange, which is based in Calgary, so it's one day trip up there back and forth. Toronto is going to take 2 days to go up and back and do all of that. Why don't we? We have over-the-counter. May it rest in peace someday. Over-the-counter is a real problem. Let me tell you the fundamental reason why it's a real problem. When you go to trade securities, say you want to go call your broker and buy a security, you go to somebody who will do that for you in the cheapest price, okay? When you do an IPO in the United States, you're paying those brokers, depends on what it is, but anywhere from 7% up for the work there. What does the trading guy get when he does a trade for you on ABC company? He gets, what, 10 bucks at Schwab and whatever else. But if they do an IPO, they get 7%. Well, when you're trading on over the counter, that's not an IPO. So those brokers are fundamentally not getting paid to make your trades. It's not worth it to them, okay? When you do it with the bigger board ones who won't take you unless you're 300 million or greater, then yeah, they'll, everybody will take that deal. You go on the roadshow around the country, everybody's gonna get a 7% on this deal. They're gonna show up, they're gonna get their clients in there because it's all money. Over the county won't support that. It's a fundamental defect in the whole program.
Can I interject? Chris, you could talk to Congressman Schweikert about this. The simple answer is every market in the world, and ASX did mention that's a good market as well, TSX London, you can pay the brokers for making a market. You cannot pay the broker to make a market in the US. It's against the rules, right? You can call it an advisory agreement or what have you, but you can't say, hey, I want you to make a market here. That will get you in a lot of trouble. So that's we're the only exchange in the world, or the only country in the world that doesn't allow that.
Hi, Dean Foote, Foote Consulting, Glendale. This question's for Tim. Why Shreveport, Louisiana? I know you found a great building there. That's great. Was it market share? Was it the labor force? Was it incentives or something else?
364 days of sunlight? No. That was an excellent deal that was that Paul came across with Stuart Lichter, one of our board members. And it was an old GM plant, and they used to build the Hummer. And so they had all the state-of-the-art equipment already in place, tested, used, all the way across the board. We were able to pick it up at a fraction, a la Tesla with their plant. And so we couldn't say no, and we went ahead and took that. Our R&D is actually done up in Detroit, and our corporate office is here in town. So we're a multi-state organization.
Hi, thank you, Nicole Rose. This question is for Tim and Ron. One thing that wasn't addressed was the strategy behind when you close out the Regulation A, because for Elio, it was very different for us than what it is for Ron.
Talk first, since I just talked. That gives me a hammock.
Thanks, Nicole. I don't know that I have a really good answer to that. We haven't closed ours out. I suspect because we use ours for a different purpose early on. It was about marketing for us and developing a base, of people who are interested in what we do, and it allowed us to do, use it as a focus group type of activity. However, having said that, now that we're through that whole process and the company's evolved and we got all new players involved and a stronger, well, it's better than a stronger team. We have a near perfect team right now. As we continue on forward, I think what we'll end up doing is we'll amend it and update the company because it's a whole different company than it was before, and then have it ready to go, and then we'll use that as we move to list on the NASDAQ. That has been our strategy all along. Our brokers like that plan. That's what they want to use, and we want to use the Reg A as the pre-IPO stock to create a float when you go list it on a major exchange. That's our plan.
Our goal was to hit $25 million. If you remember, it was very difficult because we launched this thing literally on the Friday before Thanksgiving and had to knock on people's doors and get them to respond to our request for funds. You can pretty much, like, one of the things we decided to do as a strategy, and because we had $40 million of interest, we thought we were going to be oversold. And that was after going through the list and calling out Donald Duck and Mickey Mouse and Minnie. Once we removed all that, we got together with all of our partners, took a look at the team, and we figured we should probably be able to get about 25 million. We just decided once we started to see the market kind of get cold, we decided to close the doors on it. We wanted to utilize the resources and get our R&D and everything moving forward again, so we made that call.
And how long was the offering open before you decided to do the final closing? months.
Right.
Okay, because it's, I mean, there are a lot of, I mean, several of my clients, I had one who raised 20 million recently.
Right.
And it took him 10 months.
Right.
But I will say, I mean, sometimes there are benefits to that. He got a lot of accredited investor interest just by having posted his offering, and a lot of accredited investors came along and said, gee, we're really interested, but we don't want to buy in the Reg A. And he
Right.
wound up being able to turn that into another 5 million of private placements, which he was willing to do since they weren't venture capitalists or private equity firms, which he refused to sell to.
Right.
But it took him 10 months to
Well,
hit 20.
When you're starting a new vehicle company in the United States, it has incredible capital that needs to be, an incredible amount of capital that needs to be raised. And you're also on a production timeline. Everything needs to fall within certain windows. And if one of those funding milestones isn't met, it blows the whole timeline off. I mean, let's face it, the last company to really, other than Tesla, last gas combustible company was Dodge. And it is an incredible task to do what we're doing. And so, you know, we needed to get our funds working for us as soon as possible. Our goal was to get into production, I believe at that time by 2016. And a la Tesla, those dates have been moved. I mean, it just, you know, barring getting the money from the ATVM, it put a challenge on us to go out there and raise money in different ways.
Just a quick note on that, if you're doing planning and looking at raising money, the great thing about Reg A is there is some flexibility. You can do what's called a rolling close. So you can sort of, every couple weeks, you can close the offering, take the money that you've raised that couple weeks, and then reopen the offering and raise more money, essentially. And so when you're looking at the types of businesses that are going to use this, like our business, for instance, you know, we're not building a car. We're basically doing doing paint by numbers. We're buying real estate, fixing it up, making it better, that kind of stuff. So whether we raised 5 million in our offering or 50, depending on the valuation, both could be a success for us, depending on our use of proceeds and capital. And so, you know, for Caliber, we're planning to stage our close so that we can raise a minimum amount of money that makes the offering successful, close, and then use it as a marketing tool for pretty much as long as it makes sense. Because for us, accredited investors are valuable to us because in our normal product, we raise capital from accredited investors. So if we take our 460 accredited investors today and we add 5,000 shareholders, and then we look at that base of new shareholders and there's another 200 accredited investors in there that could potentially buy our products, that's a big opportunity for us. That's a marketing opportunity. And the last thing I think I would want to add to to that conversation is that when you look at capital, some really smart people taught me at the end of the day, once you get a good business with a good concept and good people, capital is sort of the make or break. So, it's your job as a CEO, no matter if you've owned a family-owned company for 35 years or if you're starting a business from scratch, to always think about the next round of capital. Where's it going to come from? How expensive is it going to be? How's it going to affect my team? How's it going to affect me? Those types of things. And so I think with Reg A, if you structure it the right way, you can really build out that capital stack for yourself and put in an infrastructure in place that maybe you don't list your company right away, which is what our plan is. We're going to close. We're looking to raise 20 million or so. Once we close the offering, we're going to go through a couple of reporting cycles before we actually list the stock. And that's I think, another great strategy because it allows us as a company to take the money in, make sure we hire the right people, make sure our internal control infrastructure is top-notch, make sure we get through the reporting cycle on time before we have the pressure of the market and our stock trading every day. And we've squared that circle with our investors by potentially giving them some sort of negative covenant that if we don't list by a certain date, they get additional stock issued to them. So they lower the valuation that they paid or something like that. So we're still working through the details of that, but you don't have to raise this money and immediately list your stock and immediately be on CNBC constantly talking about your business to try and do IRPR. I think you can build that over time with Reg A. I don't think very many people have done that yet. I think that's a new approach, but
I was
that's
going
our
to say, so of the 27 Reg As that we've done or qualified, only one of them, Arcimoto, listed. We have another one who did a Reg A and is right now in confidential review by the SEC to list. And it's been over a year since they did their offering, but at least 3 of the deals I've been working on, they've made it clear that they will eventually try to list, but they were projecting out 2019, 2020, and obviously I made them put all sorts of caveats around that on the chance that they didn't do that. But it's not unusual to see Reg A companies decide to wait a while before listing, or for that matter, do a follow-on. I was going to ask you guys if you ever would have considered a follow-on, but once you immediately listed, or now that you're listed and you're going towards a listing, would you even consider doing Reg A again, or just?
From our perspective, I don't know that we would need to. I don't know that we would need to. I mean, it's always strategy. You guys, how much time did we spend? I don't know where Jim is, but Brian, he's a board member, and Nicole's been here. I mean, you spend half of your life in strategy meetings trying to figure out, what's the best plan. And I don't know. I've learned as I gotten older, I don't know that any plan's right. It just, when you finally get everybody to agree on something, you just kind of go that way. Our market is just sort of different because it's such a fast-paced market right now. This new zero-emission vehicles, and with the government mandates being, north of 500 million vehicles that have been mandated by governments worldwide. If all these automakers in the world stopped building fossil fuel vehicles and started building zero emission, whether it's electric or hydrogen or a combination, they can't meet 1/10 of the demand that's been created by the governments of the world. So we're in an unusual hockey stick market that kind of supports what we're doing. Hence our goal to get on to list sooner than later with an initial offering, and then possibly a year after that or so do a secondary offering to scale up after you kind of get the smoke clears from production and kind of getting in business like Tim's talking about here. It's a difficult process.
One more question?
How's it going? This question is actually for Chris. Chris, Ron and I are probably one of the few folks here in the real estate investment business, and we're with the McRae Group. This is Ron McRae. We've been around for about 38 years, right? So the question and we're starting to look to go into the Reg A plus space, maybe more and more Reg D offerings, and it seems as though you can get into this world and you start off, and most of it is you pretty much have a good real estate investment thesis. You believe it's successful. You believe it will be successful. You maybe have a track record with it in the past, but by the time you get sort of absorbed into this world, you almost get so far removed from what made you go into it in the first place, right? Which is, I'm good at real estate. And my question is how do you, how have you sort of balanced that out, right? Where you're not so sucked into the world of all of this different regulation and trying to raise capital according to all of these different hurdles. And before you know it, in an industry that's so, cyclically based, right? You almost lose track of the opportunity in the core that you're in the first place.
Yeah, real estate guy dilemma number one. No true real estate entrepreneur really wants to raise capital. They just want to do deals, and because that's really where the love is, right? And that's where the fun is, and typically that's what we're good at. And everybody makes their choice. I think that's why a lot of real estate companies stay private, stay closely held, work with a small group of investors, and that's why they do it, because they just want to focus on the real estate. Like I said, everybody makes their choice, and our choice at Caliber was that we wanted to build an enterprise. We saw a fundamental problem for individual investors, which was that 25, 30 years ago, every institution in the country figured out that investing in something other than stocks, bonds, and insurance products was the way that they could build their wealth. And until very recently, there hasn't been a way for individuals to do that in an efficient manner. But if you add these laws and technology together, you really can, if you get it right, you get the soup right. So we've decided we want to be that platform for people to be able to do that. They can come to us and say, I've got X amount of dollars, I want to put it in real estate. We can give them different solutions and give them that experience, and then be there in the ups and the downs and the good cycles and the bad, and flip from different types of real estate products and such. So to do that, you got to build an organization. It's got to be big, right? And so I think it was one of those things where we just chose to go down that path and then did whatever it takes and took the pain of learning constantly and getting beat up. We spent well over $1 million in securities lawyer fees to learn our private securities education, and which continues on a daily basis. And so, that's where it's come from. Now that we know all this stuff and we understand it, we've got the right people to work with and such, I can tell you that, real estate's one of the best places to use this, because you can open a brand new company that doesn't have any operating history. You can get it audited, and you can say, I want to raise $50 million from whoever I decide I want to raise it from, and buy whatever I want to buy, or have some thesis, make the thesis broad enough so you can change in the market, like you guys said. And what do you have to do? Well, instead of doing an annual audit and reporting to your investors privately, you have to do an annual audit and report to your investors twice a year publicly. That's it. If you don't list your stock, you don't have to be a reporting company and have investment bankers and have IRPR and all this other stuff. You just have to raise your capital with your vehicle. So, in theory, this could be great for real estate. I don't think we've seen a lot of execution of that yet, but I see it as an opportunity. Caliber, to your point, intends to do many of these offerings in the future. I would never go through this much brain damage to raise $20 million and never do it again. So, we might raise a $50 million debt fund where we pay 6% interest and we skip the banks. That once we've done it a couple of times, or once we've done it once, we've got the infrastructure in place, we can do it again. And we might do a mini hotel REIT. We might use it as a way to create a better form of a DST, so that people can use 1031 funds into real estate that aren't accredited investors. So there's a whole lot of stuff you can do with it. It's an endless wrapper, and it's about you guys, your culture, what you want to do with your company, and what direction you want to go, and what amount of brain damage you're willing to deal with. But the upside is huge. The capital is not that expensive.
Let's thank our panelists, Tim, Ron, Chris, and Jeanne, for moderating.